Good evening and welcome to this critical financial update tonight. We focus on the newly confirmed tax landscape for all American earners. The Internal Revenue Service has officially released its inflation-adjusted figures for tax year 2026. These brackets and standard deduction amounts determine how every dollar of your income will be treated, and they reflect a necessary and significant adjustment in response to persistent inflation in the national economy. These numbers are not just technical data. They represent immediate and tangible tax relief for millions of Americans, a direct result of Congress's mandate to prevent bracket creep, that unwelcome phenomenon where inflation pushes wages into higher tax brackets without any real increase in purchasing power. The adjustments for 2026 are substantial, estimated to be a 5% increase across the board compared to the previous year's figures. A movement that widens every single tax bracket and increases the amount of income protected from federal tax. We begin with the standard deduction, the single largest source of tax avoidance for the vast majority of taxpayers. This is the amount of income you can shield from taxation without itemizing specific expenses like mortgage interest or state and local taxes. The new figures for 2026 are officially set for married couples filing. Jointly, the standard deduction will climb robustly, rising from an estimated $29,200 in tax year 2025 to a confirmed $30,368 for 2026. That's an extra $1,168 shielded from taxation for joint filers. Single filers also see a welcome and material increase. Their standard deduction will jump from an estimated $14,600 to a definitive $15,184, providing $584 in added tax-free income. 4. Those using the head of household status, typically single parents supporting dependents, the deduction rises from an estimated $21,900 to $22,776, reflecting an $876 increase. These figures are essential not only for the deduction itself, but for influencing the choice to itemize. This higher threshold means many taxpayers who previously itemized may find that the new, higher standard deduction is now the more financially advantageous option, simplifying the filing process considerably. Now let's move into the detailed breakdown of the income tax brackets for 2026. These are the 7 marginal tax rates: 10%, 12%, 22%, 24%, 32%, 35%, and the top rate of 37%. The rates themselves are static, but the income thresholds where they apply are substantially higher, giving more taxpayers access to lower rates for a longer portion of their earnings. Let's first focus on the single filer tax brackets for the 2026 year. The introductory 10% bracket will apply to taxable income up to a confirmed $11,900. The next tier, the 12% bracket, begins at $11,901 and now extends up to an estimated $48,500, covering nearly $37,000 of income at this favorable rate, a significant bump for entry-level and mid-level earners. The critical 22% bracket for middle-income Americans begins at $48,501 and now runs up to $103,000. This wider band keeps many professionals and skilled workers out of the next higher tier, the 24% bracket, a key point of transition for high earners, starts at $103,001 and will now run up to an estimated $210,000. Providing a clear line for tax planning at this income level. Higher still, the 32% bracket begins at $210,001, extending all the way up to $550,000. This bracket is significantly widened to account for inflation at the upper end of the income scale. The 35% bracket then covers income from $550,001 up to the final threshold of $600,000. And the top marginal rate, the 37% bracket, applies only to taxable income exceeding $600,000. For single filers, reinforcing that the highest rate is reserved for the highest echelon of earners. Next, we detail the parallel bracket adjustments for married couples filing jointly, which again generally represent double the single filer income. Thresholds. Joint filers will see the 10% rate apply to taxable income up to $23,800. The 12% bracket starts at $23,801. And for 2026, this bracket now extends all the way up to an estimated $97,000, a massive range covering the foundational earnings of most dual-income households. The 22% rate, which impacts the bulk of the middle class, begins at $97,001 and now runs up to an estimated $206,000. This is a major inflation cushion for working families. The 24% bracket for joint filers begins at $206,001, stretching up to an estimated $420,000. This is a crucial boundary for couples managing substantial earned and investment income. The 32% rate then applies to income starting at $420,001, extending to an estimated $650,000. The 35% bracket covers income from $650,001 up to the $700,000 mark. And finally, the highest marginal rate, the 37% bracket for married couples filing jointly, applies exclusively to all taxable income exceeding $700,000. These detailed bracket adjustments are essential tools for financial planning, particularly when determining the most effective strategies for tax-advantaged retirement savings. By knowing these thresholds, you can precisely calculate the benefit of maximizing contributions to 401k Roth IRA or traditional IRA accounts, potentially keeping your total taxable income below one of these new, higher marginal rate thresholds. The IRS adjustments extend far beyond just the standard deduction and tax rates. Several key tax credits and specialized taxes have also been updated for the 2026 tax year. We start with the Alternative Minimum Tax, or AMT, exemption amounts. The AMT is a separate parallel tax calculation designed to prevent higher earners from zeroing out their tax liability through excessive use of specific deductions. For 2026, the AMT exemption for married couples filing jointly is projected to exceed $137,000, and for single filers, it will be projected to be nearly $88,000. These increased exemption levels mean fewer taxpayers will be snared by the complexity of the AMT, a significant reduction in the number of affected high-income filers. Next, family-focused tax relief has been adjusted. The child tax credit maximum amount, including the refundable portion, is also seeing a robust inflation bump. The maximum amount per qualifying child is projected to exceed $2,000, with the refundable portion itself increasing to maintain its real-world value for low- and middle-income families. Furthermore, the Earned Income Tax Credit, the EITC, which is one of the most effective measures for low-income support, is also significantly indexed. The maximum EITC amount for filers with 3 or more qualifying children is projected to exceed $7,600 for the 2026 tax year, providing a powerful boost to working families. We must also note the changes to wealth transfer and estate planning thresholds. The annual exclusion for gifts, the amount you can give to any one person in a year without tax implications, is projected to rise to $20,000 in 2026, providing greater flexibility for tax-free wealth transfers. On the retirement front, the income phase-out limits for contributing to and deducting from IRAs and Roth IRAs are climbing. The income phase-out range for making contributions to a Roth IRA for married couples filing jointly is projected to extend past the $250,000 mark, allowing a broader range of high earners to utilize this powerful tool for tax-free retirement growth. In summary, the release of these detailed 2026 tax brackets and standard deduction figures is a crucial event for effective financial management. The overarching message is clear. These inflation-indexed adjustments mean tax relief for most Americans, with more income being taxed at lower rates. However, this information must be acted upon now. If your income is stable and your tax brackets have been widened, You should immediately review your payroll withholding on your W-4 form. Over-withholding essentially translates to an interest-free loan to the government. Adjusting your W-4 to these new 2026 figures can put more cash into your paycheck throughout the year. Improving immediate household liquidity, self-employed individuals, and those with significant taxable investment income must also update their estimated tax payments calculations based on these higher bracket thresholds. Failure to do so could lead to overpayment or, in rare cases, underpayment penalties. Finally, for investors, knowing the precise breakpoints of these new tax brackets is vital for strategic asset sales, particularly long-term capital gains, which are tied directly to these income thresholds, allowing for optimized timing of sales to avoid stepping into a higher capital gains rate. These 2026 IRS figures confirm that the tax code is responding to current economic pressures, providing measurable relief and planning opportunities, but only those who proactively incorporate these new numbers into their current financial strategy will fully capture the benefits. We will continue to monitor the practical application of these changes. Thank you for joining us for this special report.